Sir, very happy morning to all. I hope that you all are preparing very well. Your preparations are going very good. This is just a value addition to your preparation where I am revising whatever we have done from section 9. Section 9 is income deemed to or accrue or arisen in India. That means certain income actually not accrued or arisen in India, but we will deem that such income is accrued or arisen in India. Under section 9, certain types of income are deemed to accrue or arisen in India, even though they may actually accrue or arisen outside India. This income may be accrued or arisen outside India, but for the purpose of Income Tax Act, we will treat that income accrue or arisen in India. Fine. Income deemed to accrue or arisen in India, we are having clause 1, that is 9 subsection 1 clause 1, 9 subsection 1 clause 2, 9 subsection 1 clause 3 and 9 subsection 1 clause 4. There are 4 clauses are there. Income deemed to accrue or arisen in India. What is the first one? Income accruing or arising outside India directly or indirectly from 3 things. Any business connection in India, or any property or asset, or any source of income situated in India, or any transfer of capital asset situated in India. And number 2 is salary earned for services in India, salary payable by government to Indian citizen for service rendered outside India, or dividend paid by Indian company outside India. Fine. So, income deemed to accrue or arisen in India, the second set is 9 subsection 1 clause 5, clause 6, clause 7, clause 8. This is the second set. This is interest, royalty, fees for technical services, or any gift, IRFG, any gift. These are the 4 things. So, these incomes are deemed to accrue or arisen in India, section 9. So, as per section 9, 8 incomes are deemed to accrue or arisen in India. In that, number 1, any income accruing or arising to an assessee in any place outside India, whether directly or indirectly from 4 sources. This is what section 9 subsection 1 clause 1. These are basic income, 4 income. Are you getting any income accrued or arisen outside India? And it is because of directly or indirectly from these 4 things. Number 1, through or from any business connection in India. So, because of business connection in India, my income is accrued or arisen outside India. Sir, through or from any property in India. Through or from any property in India. I am having a property in India, directly or indirectly I got income outside India. Through or from any asset or source of income in India, either any asset or source of income in India. And the last one, through the transfer of capital asset situated outside India. Capital asset situated outside India. So, what is the overview? Section 9 can be classified into 2 categories, part 1, part 2. In that part 1, sir, 4 incomes are there. 9 subsection 1 clause 1, 9 subsection 1 clause 2, 9 subsection 1 clause 3, 9 subsection 1 clause 4. What is 9 subsection 1 clause 1? Any income is accruing or arising outside India, either directly or indirectly through from either any business connection in India, or the second one is sir, from any property situated in India, or any asset or source of income is in India, or transfer of capital asset situated outside India. So, the reason why I am earning income outside India is because of these 4 reasons. So, technically speaking, section 9 can be classified into 2 categories, which is part number 1 and part number 2. Part number 1, you are having 4 category, 9 subsection 1 clause 1, 9 subsection 1 clause 2, 9 subsection 1 clause 3, 9 subsection 1 clause 4. In that 9 subsection 1 clause 1 is saying that any income accrued or arisen outside India, either because of either directly or indirectly, sir, either directly or indirectly through or from 4 things in India. Number 1, business connection in India. Number 2, any property in India. Number 3, any asset or source of income in India. Number 4, transfer of any capital asset situated in India. So in that, what is business connection? What and all will amount to business connection is a discussion. Yes, sir. Sir, then the second part, because once it become business connection, it will be deemed to accrue or arisen in India. Fine. Then income from property or asset or source in India, 9 subsection 1 they are talking about. Then after that, income through transfer of capital asset situated in India. Income through transfer of capital asset situated in India. Sir, capital gain arising through or from transfer of capital asset situated in India would be deemed to accrue or arisen in India in all cases, irrespective of the fact. So this is income through transfer of capital asset. So we all know that once we transfer the capital asset, what will come? Capital gain will come. Correct? That capital gain will be treated as income accrued or arisen in India, provided if the capital asset is movable or immovable or tangible or intangible. The place of registration of the document of transfer is in India or outside India. Place of payment of consideration for the transfer is within India or outside India. Accordingly, the expression through shall mean and include shall be deemed to have always meant and by means of, in the consequence or by reason of. Explanation 4 to section 9 subsection 1 clause 1. What 9 subsection 1 clause 1 is saying that, sir, any income accrued or arisen outside India, either directly or indirectly through 4 sources in India, will be treated as income accrued or arisen in India. In that, my dear lovable students, 9 subsection 1 class 1 is having one explanation. Explanation 4 is saying that, have you earned any capital gain outside India? So capital gain through or from the transfer of capital asset. So I am having a capital asset. So that capital asset I have transferred, but that capital asset is situated in India. Then income is deemed to accrue or arisen in India. Further explanation number 5. Any asset or capital asset being any share or interest in a company or entity registered or incorporated outside India shall be deemed to be and shall always be deemed to have been situated in India if the share or interest derives directly or indirectly its value substantially from the asset located in India. So this is a beautiful 2 explanation, explanation number 4 and explanation number 5. What is this topic is all about? Section 9. What is section 9? Income deemed to accrue or arisen in India. What it is saying, even though the income has been accrued or arisen in India, it will be deemed that income has been accrued or arisen in India. In that, we are having 8 types of income. In that, 9 subsection 1 class 1 is saying that income accrued or arisen in India. Fine. In that, 4 things are there. Through number 1, business connection in India. Fantastic. Number 2, because of any property situated in India, or any asset or any source of income situated in India, or the last one is through the income through the transfer of capital asset situated in India. For that, we are having 2 explanation. Explanation number 4 and explanation number 5. So what explanation number 4 is saying that any capital gain arising through or from the transfer of capital asset situated in India, which is a direct explanation, would be deemed to accrue arisen in India in all cases, irrespective of the fact that this. Whereas Sir, explanation number 5 is an indirect explanation saying that any asset or capital asset being any share or interest in a company or entity registered or incorporated where outside India, but that company is deriving value or substantially deriving its value from the asset located in India, then also income is deemed to accrue or risen in India. Cases where the asset or capital asset held by a non-resident is not deemed to be situated in India. In case number 1, in case number 2, these are exception. Come on. An asset or capital asset which is held by non-resident by way of investment directly or indirectly in category 1 or category 2 foreign portfolio investor under the Security and Exchange Board of India Regulation 2014 prior to their repeal made under the SEBI shall not deem to be or deemed to have been situated in India. This is exception as per second proviso to explanation number 5. That means if a non-resident is holding any shares or securities because of SEBI guidelines, Security and Exchange Board of India, then the income is not to be accrued or risen in India. The second exception to the explanation number 5. An asset or capital asset which is held by non-resident by way of investment directly or indirectly in category 1 foreign portfolio investor under the SEBI Regulation 2019, this is 2014, this is 2019, made under the Securities and Exchange Board of India shall also not deemed to have been, be situated in India as per the third proviso. That means again this is SEBI regulation. So I am a non-resident situated outside India. I invested in the shares or securities of India because of SEBI regulation, which may be either SEBI regulation 2014 or SEBI regulation 2019, then any income accrued or risen in India, sir, from that shares on securities will not be deemed to be accrued or risen in India. So CBDT wide circular number something bar something clarified that provisions of section 9 subsection 1 class 1 highlighted the root, read with explanation number 5. We are having two explanation number 4 and explanation number 5 relevant to the fourth limb of 9 subsection 1 class 1 shall not apply in respect of income accruing or arising to a non-resident on account of redemption or buyback of its shares or interest held indirectly, that is through upstream entities registered or incorporated outside India in the specified fund, namely investment fund, venture capital company, venture capital fund, if such income accrue or risen from or in consequence of transfer of shares or securities held in India by the specified fund and such sum is chargeable to tax in India. That means, sir, what they are trying to say is CBDT has given us clarification through circular saying that because of buyback, because of redemption of shares and all, my dear lovable students, if you are investing in the specified fund like investment fund, venture capital company, venture capital fund, this and all will not amount to income accrued or risen in India. However, the above benefit shall be applicable only in those cases where the proceeds of redemption or buyback arising to the non-resident do not exceed the pro rata share of the non-resident in the total consideration realized by the specified fund from the said transfer of shares or securities in India. It is further clarified that non-resident investing directly in the specified fund shall continue to be taxed as per the exact provisions of the Act. That means once he directly investing in India, this exclusion will not be available. But if he is investing through these people like specified fund of investment fund, venture capital company, venture capital fund, and once they redeem, then income is not to be accrued or risen in India. Now, declaration of dividend by a foreign company outside India does not have the effect of transfer of underlying asset located in India. This is circular. There is a foreign company which is situated outside India. They declared dividend outside India. Then, no underlying asset is located in India. So nothing to do with this. Now I am moving into explanation number 6. My dear lovable students, we are having explanation number 4. We are having explanation number 5. And now we are going to see explanation number 6. Explanation number 4 is applicable to the fourth limb of the 9 subsection 1 clause 1. Explanation number 5 is applicable to the fourth limb of the 9 subsection 1 clause 1. Explanation number 6. Sir, explanation 6 to 9 subsection 1 clause 1 provides that share or interest in a company or entity registered or incorporated outside India shall deem to derive its value substantially from the asset, whether tangible or intangible, located in India, if on the specified date the value of the Indian assets exceeds the amount of 10 crore. Because what explanation number 4 is saying, that it's a direct explanation, my dear lovable students. If you are having any asset situated in India, this is what explanation number 4. That is, any capital gain arising through or from the transfer of capital assets situated in India, then it will be deemed as the income is accrued or arisen from India. For example, you are a non-resident, you invested in an Indian company, shares of Indian company, you transferred that shares, then the shares of Indian company is a capital asset situated in India, then that capital gain will be taxable in India, income will be deemed to accrue or arisen in India. Okay, fine. So if I am investing, my dear lovable students, indirectly in Indian company, this is the position. So what I am doing, in order to not fall in explanation number 4, I am doing, sir, indirect transaction through explanation number 5. That's why they brought explanation number 5, and they said that if you are investing in an Indian concern or foreign concern which derive its value from an Indian company, then also income is accrued or arisen in India. Sir, this is what explanation number 5 is. An asset or capital asset being a share or interest in a company, there it may be a share or interest in company or entity registered or incorporated where outside India. I am not investing in Indian company because I will fall under explanation number 4. I am investing in the share or interest in company or entity registered incorporated outside India, which is, sir, shall be deemed to be and shall always to deem to have been situated in India. If the share, that share what you have invested or the interest derives or directly or indirectly its value substantially from asset located in India. Sir, when I can say that share or interest derives directly or indirectly substantially from asset located in India, sir, that is what explanation number 6 is altogether. That means explanation number 6 is a supporting explanation to explanation number 5. Sir, is the asset located exceed 10 crore, point number 1, and represent at least 50% of the value asset owned by company or entity as the NMAB case may be. So, what explanation number 6 is saying? It provides that either the share or interest in a company or entity registered or incorporated where outside India shall be deemed to derive its value substantially from the asset, whether intangible or tangible, located in India, if on the specified date the value of Indian asset exceeds, the amount of the Indian asset exceeds amount of 10 crore. 10 கோடிக்கு மேல Indian asset இருக்கு. And represent at least 50% of the value of all the assets owned by the company or entity, as the case may be, and that represent 50%, my dear lovable students. So, what is the value of the asset? You have to see the fair market value as on the specified date of such asset without reduction of liability. You take the fair market, the asset is equal to fair market value, less liability 0, that means you have to, without reducing liability, you should check. If any in respect of asset determined in the prescribed manner. Sir, what is specified date? The date on which the accounting period of the company or as the case may be the entity ends preceding the date of transfer of the share of an interest. However, the date of transfer shall be specified date of valuation in case where the book value of the asset to the company or entity on the date of transfer exceed by at least 15% the book value of asset as on the last date of balance sheet preceding the date of the transfer. So generally, sir, எந்த வருஷம் transfer பண்ணிருக்கியோ அதோட last date. In case 15% value increase ஆகுதுனா, the specified date will be the date of transfer shall be the specified date of valuation. Accounting period, each period of 12 months ending with 31st of March. However, where a company or entity referred in explanation 5 regularly adopts a period of 12 months ending on a day other than 31st March for the purpose of complying with the provisions of the tax laws of the territory with its a resident for tax purpose or reporting to person holding the share of interest, then the period of 12 months ending with other day shall be accounting period of company or as the case may be. First accounting period, they have given first accounting period of the company or as the case may be beginning from the date of its registration or incorporation end with the 31st March. Later accounting period shall be successive period of 12 months, next 12 months. Accounting period of entity which ceased to exist. If the company or the entity ceased to exist before the end of the accounting period, the accounting period shall end immediately before the company or the case may be entity ceased to exist. So I have not worked for 12 months, I have worked only for 8 months, then that 8 months will be treated as the accounting period. Fantastic to the core. This is what explanation number 6. So we talked about 3 explanation basically. So how the topic is routing? Section 9 we can classify into 2 category, part 1 and part 2. Part 1 is talking about this section 9 is equal to incomes are deemed to accrue or arisen in India. Even though the incomes are not deemed to accrue or arisen in India, that will be deemed as per the income tax act, those income has been accrued or arisen in India. In that section 9 subsection 1 clause 1 is saying that if you have earned any income outside India, either directly or indirectly through 4 things in India. Number 1 is business connection in India. Fantastic to the core. Number 2, sir, because of any asset situated outside India. Or number 3, because of any source of income situated in India. And the last one is, sir, because of transfer of a capital asset situated in India. That means this capital asset situated in India means you are getting capital gain. So if any non-resident is getting any capital gain from, sir, India, then it will be treated as deemed to accrue or arisen in India. For supporting this part, we are having 3 explanation given. Explanation number 4, explanation number 5 and explanation number 6. What explanation number 4 is saying that, sir, if the capital asset being a share situated in India, then income is deemed to accrue or arisen in India. This is a direct explanation which is saying that the asset is situated in India. Explanation 5 is saying that, sir, the share or the share of interest or the company's assets are situated outside India, but it derives its value from India, then it will be. So derives its what? Value from India. From India. Sir, what explanation 6 is saying that when we can say that it derives its value from India, so the Indian asset should be more than 10 crore, my dear lovable students. And 50% assets criteria we should check. With this background, I will read this question which is in the mock number 1, which is question number 4C. From this explanation, they have checked the 6 mark. XYZ & Co., an Indian company, is engaged in the business of manufacture of packing material, having its manufacturing facility in India. So there is a company called as XYZ company. Fantastic to the core. This is an Indian company engaged in the business of manufacture of packing material, having its manufacturing facility in India. XYZ company is wholly owned subsidiary of, this company is wholly owned subsidiary of Flix company, a company incorporated in country M. Okay, fine. So who has given the money? Flix company has given the money. Flix company has given the money. Pay attention. Flix company is subsidiary, wholly owned subsidiary. So XYZ company is a wholly owned subsidiary of Flix Incorporation, a company incorporated in country M. This guy is situated in country M. Angelo and James, citizens and residents of country N, some other country, country N. Each of them hold 50% of the share capital of Flix Incorporation. So this Flix Incorporation is owned by Angelo and James. So Angelo is holding 50%, James is holding 50% because each of them hold 50% of the share capital. Angelo and James each had invested equivalent to INR 100 crores in Flix Incorporation in April 2015. So Angelo has invested 100 crore and James has invested 100 crore. So Angelo and James put together they invested in Flix company, and Flix company have fully invested in XYZ company, and this guy is situated in India. On 1st June 2023, that is during our previous year, Angelo and James have received an offer which they believe was fair, fantastic, sold their entire stake in Flix Incorporation to Ishan. So this holding Flix Incorporation, they have sold to Ishan Kishan, fine, a resident of country N, for an amount equivalent to 350 crores each. So Angelo got 350 crores and James got 350 crores. both got 350 crores. The accounting period of Flix Incorporation is January to December. Sir, we just now studied that. Accounting period may be 31st of March, but this accounting period is from Jan to December. The relevant extract of the balance sheet of Flix Incorporation as on 31st December, that is a year end, 1st June. What is the 1st June? Is there any relevance for 1st June? Sir, on 1st June only they have received the offer. That is on the date of transaction. So we have to check that 15% condition. If the value exceeds 15%, on that date we have to value. So the accounting period of Flix Incorporation is January to December. The relevant extract of the balance sheet of Flix Incorporation as on 31st December. The 1st June and 31st December 2023 are as follows. So opening, mid date, end date. Details regarding the Flix Incorporation. Book value of the asset. This is book value. Book value as on 31st December 2022 is 1000 crores in INR. As on 1st June 2023, 1300 crores. Fine. 1000 from 1000 it has jumped to 1300. At the year end, 1500 crores. Okay, fine. A liability, sir, 300, 250, 350. Fine. Fair market value of the asset without reduction of liability, that amount we need 800 crores, 1100 crores, 950 crores. Details regarding investment in XYZ company, our company. Cost of acquisition, this is how they have 150, 150, 150 because cost of acquisition anyway will not change. Book value of asset in balance sheet of XYZ company. In book value they have changed 350 crore, 550 crore and 480 crores. Fine. Liability, fair market value of assets in balance sheet of XYZ company without reduction of liability. Right. Liability is 150, 200, 250. Fair market value of the asset in balance sheet of XYZ company without reduction of liability 350, 600, 600. Fine. Determine whether the income arising from transfer of shares of Flix company chargeable to tax in India in the hands of Angelo and James for the assessment year 24-25. Assume there is no DTA between India country M and between India country N. No DTA confusions are there. So 6 mark is what the question has been asked. So look at it. In order to tax an income of non-resident in India, income should be accrued or arisen in India as per section 9. We are having 8 clauses in section 9, 9 subsection 1 clause 1 is saying that any income accrued or arisen outside India through a business connection in India or because of an asset situated or in India, because of an asset transferred situated in India or because of any source or asset which is situated in India or transfer of any capital asset situated in India. For the transfer of any capital asset, we are having explanation number 4, explanation number 5 and explanation number 6. Explanation number 4, directly if you are transferring any shares of India, then income is deemed to be accrued or arisen in India. Explanation number 5, you have not transferred the Indian share, you have transferred the foreign share like this company, but that share is deriving its value from India, then it will be treated as income has been accrued or arisen in India. My dear lovable students, what is that when we can say that income is deemed to accrue or arisen in India? 2 conditions should be satisfied. That's what we have understood here. Number 1, the Indian asset value should exceed 10 crore and it should represent at least 50% of the value of all assets owned by the company or entity as the case may be. So with this backdrop, we are going to check the answer for 6 mark. Capital gain arising in the hands of Angelo and James from transfer of capital assets situated in India would be deemed to accrue or arisen in India. Section 9, subsection 1, clause 1. Share of Flix Incorporation, country M, shall be deemed to be situated in India if those shares derive directly or indirectly its value substantially from any asset located in India. Fantastic to the core. Share of Flix Incorporation would be deemed to derive its value substantially from asset located in India if on the specified date, the fair market value of Indian asset, the fair market value of Indian asset, not the book value, fair market value of Indian asset without reduction of liability. Don't see the liability part. That is the fair market value of asset of XYZ company, because the Flix Incorporation, sir, in that Flix, Angelo and James. So Angelo and James invested in Flix, invested in XYZ. Fine. exceeds 10 crore, the fair market value exceeds 10 crore and represent at least 50% value of all the assets owned by Flix Incorporation. So Indian asset value wise should be more than 10 crore, percentage wise it should be more than 50%. Specified date would be the date of transfer, that is 1/6/2023. Why? Since the book value of asset of Flix Incorporation, for that I am not taking the fair market value, I have to take the book value. The book value of Flix Incorporation on the date of transfer 1300 crores exceeds the book value of asset as on the last balance sheet date preceding the date of transfer, that is 1000 crore by at least 15%. Because on the last balance sheet date, my dear lovable students, it was the book value of the asset of Indian company. Here it is. The book value of asset is Flix Incorporation is 1000 crores, the Flix Incorporation, but it has raised to 1300 crore. So the specified date would be the date of transfer. Otherwise, I will take 31st of March. Since the book value of the asset of Flix Incorporation on the date of transfer, that is 1300 crores, exceeds the book value of the asset as on last date, balance sheet date preceding the date of transfer, that is 1000 crore by at least 15%. Where this has been, this is what specified date. Normally the specified date means the date on which the accounting period of the company, or as the case may be, the entity ends preceding the date of transfer of the share of an interest. Generally specified date means 31st of March or 31st of December if they are following that. However, the date of transfer shall be the specified date of valuation. In case where the book value of the asset of the company or entity on the date of transfer exceeds by at least 15% by book value of the asset on the last balance sheet date preceding the date of transfer. So as compared to the last balance sheet date and the date of transfer, if there is an increase of 15%, then I will take the book value on the date of transfer. Share of Flix Incorporation derive its value substantially from asset located in India. Since the fair market value of the asset located in India without reduction of liability on 1/6, I have explained why on 1/6, being the specified date, that is 600 crore exceeds 10 crore, because the amount wise it is more than 10 crores, because they have given details regarding the Flix book value of asset and liability. They have given fair market value of the asset without reduction, sir, it is 1100 crore. This is on the date of the sale. Is this 1100 crore more than 10 crore? Why not? So, my dear lovable students, being the specified date, that is on the specified date of 1/6/2023, shares of Flix Incorporation derive its value substantially from asset located in India. Since the fair market value of asset located in India without reduction of liability on 1/6/2000, fair market value of asset in balance sheet of XYZ and Co. These are two company details. This is details regarding the Flix Incorporation. Avangaloda book value, avangaloda liability, avangaloda fair market value without reduction of liability. These are the details regarding investment in our company XYZ Limited. Avangaloda cost of acquisition, avangaloda book value, avangaloda liability, avangaloda fair market value of asset in balance sheet of XYZ company. Fine, fantastic to the core. And this date you should be very careful. This is the normally specified date. But book value of the Flix Incorporation exceed 15%, we have to adopt on the date of transaction. So 1st June. So shares of Flix Incorporation derive its value substantially from asset located in India. Since the fair market value of asset located in India, fair market value of the asset located in India without reduction of liability on 1/6/2023, being the end date, specified date, that is 600 crore. So this is details regarding the Flix Incorporation. This company is situated outside India. This is details regarding the investment in XYZ company. So this is our Indian company. Avangaloda fair market value has exceeded 6, sir. On the date of specified date, it is 600 crore, which is exceeded 10 crore. So that is 600 crore exceeds 10 crore and represent more than 50%. That is 54.545% on the fair market value of the asset of Flix Incorporation. What is the asset of value of Flix Incorporation? The Flix Incorporation value is 1100 crore. Suppose 600 divided by 1100 into 100. So 600 divided by 1100 into 100 means 54.5 54 percentage is the percentage which is more than 50% value. அப்போ total asset of foreign company ஓட value wise பார்த்தேன்னா 10 crores மேல இருக்கணும். Total asset ஓட 50% மேல Indian company ஓட asset இருக்கணும். If these two conditions are satisfied, we can say that the shares of the foreign company has derived its value from Indian company. Once this condition has been satisfied, we can say that, my dear lovable students, income has been deemed to accrue or arisen in India as per section 9 subsection 1 clause 1. Hence the shares of Flix Incorporation would be deemed to be a capital asset situated in India. இனிமே அந்த ஷேர் இந்தியாவுக்கு வெளியே இருக்கிறது கிடையாது, இந்தியாக்குள்ள இருக்கிறது. And capital gain from transfer of shares of Flix Incorporation by Angelo and James would be deemed to accrue or arisen in India. Accordingly, the capital gain from transfer of shares of Flix Incorporation would be taxable in the hands of Angelo and James in India as per the Income Tax Act 1961. So they have tested from section 9 for 6 mark. So the consolidation is, they have tested mainly this part, which is explanation number 6. Now when you read, you are having 1000% clarity. Sir, explanation 6 to section 9 subsection 1 clause 1 provides that either share or interest in a company or interest in an entity registered or incorporated outside India, according to us it is Flix Incorporation, shall be deemed to derive its value substantially from the asset, whether tangible asset or intangible asset, located in India. For example, our company, that is XYZ, in XYZ company, right, located in India, that is XYZ. If on the specified date, we are having a definition of specified date. Generally specified date means the last year and date. But if there is 15% change, increase, we have to take the date of transaction as the specified date. The value of Indian asset exceeds the amount of 10 crore. Value of Indian asset. So you have to go and check the Indian company. So XYZ companies in a asset should be more than 10 crore. That means that foreign company should hold more than 10 crore value of asset in India. Yes. Represent at least 50% value of the all the asset owned by the company or entity as the case may be. That foreign company, out of their assets, the Indian assets, when you compare, it should be more than 50%. What is the value of asset? Value of asset does not mean book value. You have to take the fair market value as on the specified date of such asset without reduction of liability, if any, in respect of asset determined in prescribed manner. What is specified date? Generally the date on which the accounting period of the company or as the case may be the entity ends, preceding the date of transfer of the share of an interest. For example, June I have transferred, 31st of March I should take. However, the date of transfer shall be specified date of valuation. In case where the book value of the asset of the company or entity on the date of transfer exceeds by at least 15% of the book value of the asset on the last balance sheet date preceding the date of transfer. In case, sir, year end kum date of transaction kum 15% book value change irukna, the date of transfer should be taken as a specified date. Fine. This is exceeds. So positive, there should be an increase of 15%. What is accounting period? Generally 12 months. Sir, ending with 31st of March. But outside India, we cannot force that April to March should be the accounting period. So they may take what man normally from, sir, Jan to December also they can take. First accounting period means company ஆரம்பிச்சிட்டு first என்ன சார் 31st March எப்போ வருதோ அதான் first accounting period. Later accounting period successive என்ன சார் every 12 months or later accounting period. In case company stops in between, they are selling in between, then that bit that is which may be less than 12 months can also be treated as the accounting period. So this is what they have tested. If for 6 mark in examination, I believe that you will be having a perfect clarity over section 9 subsection 1 clause 1. Sir, I have done one more question from MTP which needs a revision for you, my dear lovable students. If you feel that any particular area you want to revise from my side, just inform me in the comments. I will revise for you. I am wishing you all the very best. Whatever we have studied thoroughly, you revise. That itself is more than enough for examination. Study very well and all the best for your exams.